Welcome to the Office of the State Controller's 2 CFR 200 Uniform Guidance Micro-Training Series. This series contains 13 separate micro-trainings on various 2 CFR 200 parts. This video provides an overview of equipment and real property under 2 CFR 200.313 and 436. Let's get started. In the case that the federal award and the state awarding agency allow for the purchase of equipment, it is the responsibility of the subrecipients and the funding state agency to ensure that equipment purchases are procured and managed in compliance with uniform guidance, specifically 2 CFR 200.313 and 436. Procurement of equipment should comply with 200.320. Once equipment is purchased, it must be used for the intended original purpose of the grant. For example, if a van was purchased to transport kids to after-school activities, that van could not be repurposed as a mechanic's van without permission. That said, assuming that sharing the equipment wouldn't interfere with the program's work, it could be shared with other federally funded programs. So in the example, while kids are in school, the van could be used to support a federal program transporting senior citizens to medical appointments. In the case that the grant ends or no longer needs the equipment, it may be used for substantially similar activities supported by the same funding source, and if not available, similar activities funded by other federal agencies. The intent of this regulation is twofold. First, to ensure that grant funds, in the form of equipment, continue to be used for the purpose for which they were granted, and second, to minimize waste by fully utilizing existing equipment whenever possible. So, once equipment has been procured and is being used for eligible purposes, what are the federal requirements for managing the equipment? Generally, the feds expect the equipment to be tracked and well maintained. Specifically, equipment must reside with the subrecipient and be properly insured and maintained in working order. It also must be inventoried with property records that include, at a minimum, the description of the property, serial or other identification number, source of funding, and percentage of federal dollars used, identify who holds the title, acquisition date, the cost of property, location, use and condition of the property, and when relevant, any disposition data, such as the date of disposal and the sale price. A physical inventory of the equipment must be taken every 2 years, and the equipment must be safeguarded from loss, damage, and theft. So the van couldn't be left unlocked with the keys under the mat. That wouldn't demonstrate appropriate care for the equipment. If something does happen to the equipment, like loss, damage, or theft, it must be investigated and noted in the files of record. So what happens if a recipient of grant funds no longer has need for the equipment that was purchased with the grant funds? The final disposition of grant-funded equipment must be informed by the federal award agency. In some cases, disposition instructions may be listed in federal statute or awarding agency instructions. But if not, instructions must be requested from the federal awarding agency. All federal agency guidance must be followed for the disposal or disposition of federally funded equipment. But generally, if an item has a current fair market value of less than $5,000, that item may be disposed of or sold or retained with no further responsibility to the federal funding agency. If a piece of equipment If a piece of equipment's current fair market value is greater than $5,000, typically the awarding agency will be entitled to a portion of any sales proceeds, or the title may be transferred to the federal government or an eligible third party. Generally, the portion due to the awarding agency is the percentage of the project paid by the agency times the sales price. So for example, if the van was sold for $10,000 and the federal awarding agency originally funded 50% of the project, the feds would be due $5,000 from the proceeds of the sale. In some cases, the sales costs can be adjusted for selling and handling expenses. As an additional consideration, subrecipients of federal funding can be compensated for the use of buildings, capital improvements, equipment, and capitalized software projects when used for activities funded by a program through allocation of depreciation expense. When claiming depreciation expense, a subrecipient of federal funds can claim depreciation as a project expense, for example, a direct or an indirect program cost, or as match, but depreciation can never be claimed as both. Additional details on depreciation are addressed in 2 CFR 200.436, which offers concrete guidance related to the treatment of depreciation expense. Generally, though, depreciation can only be claimed as a reflection of consumption of the asset over its useful life and should be consistent over time. For example, a hospital may need to purchase an expensive piece of medical equipment to engage in a research project. Over the years, the piece of medical equipment loses value as it gets older. Depreciation is a way of accounting for that loss of value, and the hospital can charge that loss of value at a consistent rate over the useful life of the equipment. To clarify, the hospital couldn't charge the full value of depreciation of the equipment in the first year because the equipment hasn't actually depreciated that much yet. But the charges must be roughly equivalent to the loss of the value of the item. As a note, a building may be treated as a single asset or divided into multiple components. For example, the building shell, mechanical systems such as HVAC and plumbing, as well as fixed equipment. As always, treatment of depreciation should be consistent. Finally, when booking depreciation expense, the methods used for charging federal grants should be the same as those used for financial statements, and no depreciation may be allowed on assets that have outlived their depreciable life. If charging depreciation to a grant, all expenses must be supported by property records and physical inventories taken at least every 2 years. Real property purchases, essentially land and building structures, must be eligible under 2 CFR 200 and awarding legislation. In the case of SLFRF, this is the SLFRF final rule and authorizing state legislation. Any real property purchases funded with federal funds must be used for the intended original purpose of the grant as long as needed for that purpose, and title or interest in the property may not be disposed of or encumbered prior to formal disposition of property. If a piece of property is purchased for a homelessness initiative, that property may not be changed into a medical facility without formal disposition instructions from the original awarding agency. So what happens when a program would like to repurpose or sell a piece of real property? Just like with more modest equipment purchases, the federal awarding agency must inform the process for disposition. Generally, one of 3 paths are likely. The subrecipient can retain the title of the property after paying the federal awarding agency the appropriate repayment amount. The subrecipient can sell the property and pay back the awarding agency, or they can transfer the title to a federal awarding agency. 2 CFR 200 has detailed instructions on each of these processes and recommended repayment calculations in 2 CFR 200.311. This concludes this session on equipment and real property. The resources listed here pertain to equipment and real property and will provide additional information to round out this topic. As always, please feel free to reach out to the OSC compliance liaisons listed here. Each compliance liaison is assigned to a series of departments and have a backup liaison noted in parentheses under each department. Thank you for viewing the Equipment and Real Property Microtraining series, and reach out to us if you have any questions.